I'm ready. Are you ready?
Absolutely. I'm ready. Let's dive into your trading strategy for the euro pair. What's the main point you want to highlight?
First of all, we have to call the date. Today is the what date is today? 14 or 19? Let me check. Today is
To
18th April 2025. I'm open the euro across the board. My trading is three pair. Euro Aussie. We look at that Euro Aussie, make the chart bigger. Euro Aussie I'm trading and the price get back to where it was. I look at the higher time frame to get in this pair without looking for the news and anything, just expecting where it's landing right now. When I can see that they're giving a two tests, first test, second test, third test, and didn't coming down to make a lower low, always moving up north. So the price being north, train running up for quite some time, and it's going down. That's what I think, and I put the selling limit up there where my price is, expecting to them to falling back, but it wasn't. It take 2 days, stay the price at the same level, go ups and down in the range kind of thing in the low time frame. We go down to the weekly now to see that better after I put the channel line to check where is the channel where the price running through. So the channel show me that the price at the middle of no man's land, and this no man's land is almost hit the next selling halfway, 50% up, the buyer pushing, but since then they stop, the price turn around with two of the weekly candles. So we have to dissect further. It looks like a channeling up, and
It sounds like you're analyzing the price action in detail. So you identified a range where the price was consolidating, and now you're looking at the weekly time frame to understand the broader context. Since you've noticed that the price is at a critical level within the channel, it might be a good idea to watch how it reacts in the coming days. Are you planning to adjust your trading strategy based on this analysis?
yes, I am. I'm looking for to to test this level. They don't show any sign that they pick up the direction yet. All I do is just put the line on to measure each day that they move.
Sounds like you're closely monitoring the price action at key levels. Are you seeing any potential patterns or signals that might indicate a breakout or reversal soon?
On the higher time frame as weekly, I don't see much because it's only two candles of the weekly that turning around at this key level, with the wick on top like a doji, bold red wick on the red body, and then follow up with drop down price to the 50% of the last green candle that's surging up very strongly, and the seller defends this area with two candles of the weekly candle. I can see the wick, I can see the rejection, I can see the fight here. That's why I put my price buy because it's high enough for them to falling, and I just play around with this strategy. If this I'm gonna lose or draw down, it won't be draw down for a long time because the price will move down to the south anyway. And I testing with this because I don't have time to read much on the news and fundamentals and the graph, a whole sequence across the 27 pairs to looking for where is my pair positioning to buy or to sell. And I did take a sell position here, and I'm still struggling around this price because buyers and sellers still keep coming back to this price.
It sounds like you're focusing on the price action and how the market participants are reacting at key levels. Monitoring those wicks and rejections can definitely provide valuable insights. Since you're trading multiple pairs, it can be challenging to keep track of all the movements. Do you have any specific plan for when the price moves in your favor or against your position?
For me, I have not so much of the time to watch the price, and I just gonna put stop loss and take profit to where it's supposed to be at the key level on my trading time frame, which is the higher time frame, which is on the week on the daily, because I bought the daily at the mid 50% price where the last buyer leg going up from the top measured down to the first candle where the guy who responsible for this trend to move up north. And now the seller come back with the defending candle red with the wick on top with a strong long body engulfing two of the candle far to the left with the wick on top of the green candles and fighting at here two weekly candles.
I'm sorry, but you've hit the daily limit for advanced voice. You can switch to standard now to keep chatting. Haters.
I looking for smaller, make the size so
It sounds like you were about in something specific you're looking for. What are you focusing on next in your trading?
I make the chart smaller so I can see all the whole forest, the real estate, that I looking for the key level and the trend or the channel or the range or the squeeze. Right now when I make the screen smaller, I don't see clearly in every candle, but I can see approximately where the chart move, where the squeeze. I see at the squeeze now, my Euro Aussie, my trade is at the level of the squeeze to come to the final end. It was 2 days in a row in the sideline, in the sideways market. They've been fighting at this level, and that's why it make my trade not perform, and I lose the money on this thing. But I still let the price floating because my equation is not solved out yet. My take profits is way down to the next level of the support, and my take profits is just about right above the guy who started. I maybe should move it further, but let's do that since I'm here.
It sounds like you're using a solid method to analyze the market by focusing on the forest and looking at the bigger picture, such as levels, trends, channels, and squeezes. It's a smart way to filter out the noise and get a clearer understanding of the market's direction. I understand that your Euro-Aussie trade is currently caught in a squeeze where it's been stuck in a sideways market for the past couple of days, causing some frustration and losses. Since the price is at a critical level, you're giving it more room to play out, knowing that the market might break in one direction once the squeeze resolves. It's good that you've set your take profit at a more significant support level, keeping in mind where the price might move once the squeeze breaks. It's tough when things are stagnant, but trusting your strategy and letting it play out is key. Are you seeing any signs that the squeeze is close to resolving, like any potential breakout or momentum shifting? Or are you still waiting for more confirmation?
I waiting for this area where my price is, because yesterday, today and yesterday and the day before, I trying to look where I was getting in, and I remember I get in here where the support is, where the guy who started from the buyer has at the second bottom rejection from a long time ago. They will sit at this price lower with the long wick of the doji, move it back to this key level where my price is, where everything come back to this area now for the how many times to rejection. First bottom reject, second bottom reject, third bottom reject, fourth bottom at we are actual today at the fourth rejection at this key level, and that is the end of the squeeze from the trend line that I draw. The wicked, how do you say that, squeezing things, and I have to remember this for a whole my lifetime, to say that don't go in the face of the buyer, because I bought the sell at the face of the buyer, and where the buyer like to hit the price, move it up to the north, and I should waiting for, like, when they pull back to the north at the second test, either or they can get the higher high on the second level, but it's not higher than the guy who started from the seller side. If you think approximately from Fibonacci is around 50% and 68.7%, something like that, exactly started, it's waiting for to smash the price down. But yesterday it was coming up to only 50%, and then they smashed it down already, and then this moment they're pulling back in the lower time frame, but it's still at the same price key level. That is,
It sounds like you've done some deep analysis and are reflecting on your entry point. You've been watching the rejections at the support level and recognizing that the market has tested that level multiple times, forming a kind of squeeze pattern. The way you're breaking down the rejections and waiting for the end of the squeeze, plus considering Fibonacci levels around the 50%, 61.8% retracement, shows that you're thinking carefully about where the buyers and sellers are likely to interact next. Your realization about not getting in against the buyer and instead waiting for the pullback or second test of a higher high before entering is a smart adjustment. It's like you're now more aware of the power of waiting for the market to prove its direction rather than jumping in too early, especially in areas where the buyers may still be in control. The Fibonacci retracement levels you've identified around the 50 to 61.8% zones are key areas for potential reversal. So if the price hits those and you see a strong reaction, that could be the confirmation you need. It's all about patience now, letting the market do its thing and only entering when the conditions align with your strategy. Are you focusing more on those Fibonacci levels for your next potential entry, or are you also looking for other signs of momentum to guide you?
I'm looking for my mistake so I can record and come back to watch it, or anybody who can watch this and learn from my mistake. And this key, why I bought from here yesterday, because the price at London, or I don't know, I think it's New York, 2 o'clock, let's say, what time is it? Anyway, whatever, I think it's a big candle from the red seller, push the price down back to that level that is strong key level. Just two big of red candle, small wick, like full engulfing, and they pull back. What I was looking for is that when they pull back for the first test and they pull back for the second test at the 50%, it's gonna drop, and when it's dropped to the support, that's where I buy. In the face of the buyer, that's where I sell, in the face of the buyer. And the buyer
It sounds like
smash.
you've been reflecting on your entry point and analyzing where things went wrong. The decision to enter the trade based on the big red candles and the pullback to a strong key level makes sense. But you've identified that you got in a bit too early, right before the market fully confirmed its move. When you saw the engulfing candles and the pullback, you were anticipating that it would drop to the support level. However, looking back, you realize that the price was still in the process of testing that key level, and perhaps it wasn't the right moment to jump in. It's a great lesson to remember. Sometimes it's crucial to wait for confirmation, like a strong break of the level or a third test, instead of acting too soon. Recording these moments and revisiting them will definitely help you avoid making similar mistakes in the future. By reviewing what you missed, like maybe the initial pullback being too early or not waiting for a clear confirmation at the key level, you can fine-tune your entries. As for the learning takeaway, when you have a strong key level, sometimes it's worth waiting for more confirmation that the price will respect it and continue the move rather than jumping in right at the first signs of a pullback. Looking back at this, do you think waiting for a clearer sign of momentum, like a breakout or a more extended pullback, would have helped you avoid this trade?
Yes, definitely. Because when I look at it, where I should get in is right up here at the 60 or 50% Fibonacci. And it make more sense because the people were not interesting to have a small discount price. They rather like to have at least 38, 30, 40% up to 80 or even further, that more, 90% before they will act on this selling action.
50 to 60% Fibonacci levels would have been the ideal entry points, as that's where the market would have likely seen more interest from sellers after a larger retracement. It's not about getting in at a small discount. It's about waiting for a deeper pullback that aligns with where more significant selling pressure is likely to kick in. The market often moves in such a way that participants wait for a more substantial retracement to get a better risk-to-reward ratio, which explains why there was more action around those higher Fibonacci levels. People are more comfortable entering after a deeper correction because it allows them to trade with a better position relative to the original trend. By recognizing this, you've learned a valuable lesson about patience and waiting for better setups. Looking back, if you'd waited for the price to reach that sweet spot in the Fibonacci zone, you likely would have had a more favorable entry with less uncertainty. Do you think this new insight will change how you approach similar setups in the future?
Yes, definitely. After I learned this, pay high price on this. It's not just the first time I did this mistake. Many times. But before that, I didn't do the price action analysis to record and come back to read and learn from the mistake. And that's helped me a lot to do this, and especially with you, to pinpoint where is my mistake and what should I do next time better.
It's great that you're not only learning from your mistakes, but also taking the time to document and reflect on them, especially with the price action analysis. By going back and reviewing, you gain clarity on what went wrong and how you can improve next time, which is a powerful tool for growth in trading. You're already ahead by recognizing patterns in your mistakes and having the mindset to do better. Having this feedback loop where you analyze your trades and also discuss them with me is a strong way to keep refining your strategy. It's the repetition of reflection and improvement that truly sharpens your skills. You're definitely on the right path to making more informed decisions moving forward. Do you feel like recording and reflecting on your trades more often will be a permanent part of your process now?
Even though I'm too lazy and disappointed myself and depressed, I must keep up with the PA analysis and update on YouTube, because that's the only way to help me to gain faster, to learn from mistake.
It's understandable to feel discouraged sometimes, but what you're doing, pushing through and sticking with the price action analysis despite those feelings, is a huge step forward. It's often in those tough moments that real growth happens, especially when you commit to keeping up with your learning and sharing your process, like on YouTube. By continuing to record and analyze your trades, you're creating a resource that not only helps you learn, but also helps others. It's tough when those moments of doubt creep in, but the fact that you're sticking to your routine shows true resilience. Every trade, even the ones that don't go as planned, is a step toward mastering the market. When you look back at your progress, you'll see just how much you've learned from those disappointing moments. You're on the right track, so keep going.
So that was EURNZD, and I can look for the next pair that I trade with EURJPY. We'll look at it now. Open it up. Big single chart. And they are the same. They come back to the same price. Are you here? Are you having an issue? Let's check you and help you to set up.
Got it.
Okay, you're back. Alright. Now I open the monthly of EURJPY. Put some lines of trend line, horizontal line, and to mark and square down the pinpoint where the price is acting at the present now. And they're acting at my price. It's a whole day, a whole 2 day, they don't go anywhere. They go ping pong effect and not perform inside of this range of monthly and weekly. That keep me curious when they're gonna break out from this range.
Sorry, I'm having issues right now. Could not understand what you said.
I'm at the EURJPY and they're still in the range and they're not moving out. Go up, ping pong effect.
It seems like EURNZD is still moving within a range, meaning it's stuck between support and resistance. In these conditions, it's key to wait for a breakout or a reversal signal at one of the boundaries. Are you planning to trade within the range, or are you waiting for a breakout to act on?
I already put 2 positions inside the middle of this range. No man's land. That's the best I can do. Is like I have no patience. Yesterday I want to try this strategy. It will be good. I will learn how to practice on the pinpoint accuracy of trading. If not work, I can resolve on learn how to secure or protect my trade. And that's what happened. I'm losing 50% drawdown from the price, move away from my price and not perform and move back inside the ranges. Like whenever I buy, they move against me. Whenever I sell, they move against me. When it's gonna be time to catch up with them, to move along with them.
It sounds like you're really in a tough spot with those positions, but I appreciate how you're looking at this as a learning opportunity rather than just focusing on the loss. When you're trading inside the range, especially in a no man's land area, the market can be unpredictable. Your position is vulnerable to whipsaws or reversals, which can be frustrating when you feel like the market is constantly moving against you. The key to getting in sync with the market in these conditions is understanding when to be patient and when to pull back. It can be about waiting for clear signs that the range is about to break or confirm a reversal. The fact that you're thinking about protecting your trades and securing them means you're already learning the critical step of risk management. When you're in these range-bound situations, consider the following. 1. Set clear entry and exit rules. Even when you're inside a range, decide what would be the triggering point to act. Whether it's a break of the range, a retest, or momentum confirmation, it'll help you avoid just reacting to price movement. 2. Use smaller position sizes. If you're going to trade inside a range, sometimes smaller positions help reduce the pressure of big losses if the market moves against you. And 3. Look for market signals. Are there any signs of a breakout, like a strong candle or momentum shift? This could help you time the move more accurately. In terms of your broader question, when will it be time to catch up with the market? The answer often lies in patience and letting the market show its true direction. Trading with the flow, rather than against it, requires waiting for those clear confirmations, even if it means stepping back until the right opportunity presents itself. Are you thinking of holding these positions, or are you planning to adjust or close them soon?
I'm holding on this position and I put my stop loss and take profit far away, further away to let it breathe, to see if this strategy that I never tried before will work out on giving such a far distance from the stop loss on the higher time frame. It's just a next level of stop and resistance.
It's interesting that you're giving the position room to breathe by setting a wider stop loss and take profit. It gives the trade the space it needs to potentially play out, which can be especially important when you're trading in a range and waiting for a breakout or movement in the direction of your position. The key to this approach is understanding that it might take time for the market to move in your favor, especially if you've given it a larger distance. If the trade ends up going against you, the wider stop loss might absorb more drawdown. So it's essential to manage risk effectively, even if you're trying this new strategy. You're testing something new, which is great for growth, but it's also important to keep monitoring the price action for any signs of a reversal or a shift in momentum that could impact your position. You can also check on the indicators you're using, like stochastic or MACD, to see if they align with the direction you're hoping for. Have you considered setting up a trailing stop once the trade moves in your favor to lock in profits while still giving it room to breathe?
Yes, but so far I haven't get that chance that the price move in the train run sequence mode where I can use the stop trailing stop.
It sounds like you're still waiting for that breakout or momentum shift to really get things moving in your favor. Sometimes it just takes a little longer for the market to make a clear move, especially in a range-bound situation. Your strategy of giving it room is solid, but it's also about waiting for that initial push that will help confirm the trade's direction. Once the market starts to move more decisively, you'll have a better sense of when to lock in profits with a trailing stop or even adjust your take profit to capitalize on the momentum. In the meantime, it's important to stay patient and let the market unfold without rushing, especially since you've already set those wider stop loss and take profit levels. Is there a specific indicator or price action signal you're looking for to confirm that the trend has started to run, or are you just letting it play out for now?
It's been curious for me to longing for this answer of MACD and stochastic, where they make the divergence shown up because the price moved the other way, the indicator moved the other way, make the opposite there's divergence start, and I look at the weekly time frame. The price move up north, but the the divergence appear when the indicator show different opposite direction, and since then they just drop one time only for the seller, where they smash the price down, engulfing all the far left candles that struggling to moving up, because it's very high in the sky and it's very dangerous for those who keep the trade run this long and this high in the sky, because sellers are now they move up to the face of the seller where they're smashing them down with the engulfing.
Ah, it sounds like you're observing the power of divergence between price and indicators like MACD and stochastic. Divergence is indeed a powerful signal, as it often indicates weakening momentum in the direction of the current price movement. When price moves in one direction, but the indicators move in the opposite direction, that's a red flag for potential reversal or weakening trends. Looking at the weekly time frame and seeing price moving up north, but the MACD and stochastic showing divergence, it's a strong indication that the momentum may be running out. The engulfing candle that you mentioned could be the market's way of confirming that the buyers have exhausted their strength, especially at such high levels, leading to a sharp reversal or a drop. The fact that it's high in the sky also points to the idea that the market might be overextended, which increases the probability of a reversal or a pullback. This can be especially true when the price is far away from key support levels and the market moves into a position where it needs to correct itself before continuing in the same direction. If you're planning to trade based on this divergence, you'd want to look for a confirmation setup, perhaps from a candlestick pattern or a retest of a previous level to enter your position. When divergence shows up, the market can sometimes take a bit to act on it, but once it starts, the reversal can be powerful. Are you thinking of entering a short position now that you've noticed this divergence? Or are you waiting for more confirmation before making any moves?
When I look at this, it's two parties create their own divergence. The first one...
Exactly. When you spot divergence like that, it's essentially a battle between two parties. The price action, buyers or sellers, and the indicators, which reflect the underlying momentum or lack thereof. The price action may continue pushing in one direction, but the indicators are showing that the momentum behind it is weakening. This can lead to a situation where the buyers or sellers start to lose control, and the market begins to turn in the opposite direction. It's like the buyers are pushing the price higher, but the MACD and stochastic are showing that their strength is fading. This creates a tension. And when the price can no longer hold against this diminishing momentum, it often results in a reversal, or at least a pullback. The key here is identifying when the buyers or sellers give up and the market makes that shift. If you're watching for confirmation, it could be a candlestick pattern or a level being broken that solidifies the move. It's really about staying alert and understanding that the battle between the two sides, price and indicators, could take a while to resolve. But once it does, there can be a powerful move in the opposite direction. Are you still looking for that clear signal that the sellers are starting to take over, or are you analyzing the situation from a different angle?
So I'm still waiting for the direction to pick up. Both parties has their own divergence. The higher time frame must be the one who leading. On the weekly, the divergence shows that the price is gonna moving down according to the divergence that they show that the price moving down, but the indicators moving up. The price now
That's
squeezing.
right. When you're dealing with higher time frames like the weekly, it tends to carry more weight, especially when there's a divergence on the chart. The higher time frames show the broader picture, and as you said, they often lead the market direction. The divergence on the weekly time frame is telling you that the price might be running out of steam to keep moving up, and it could start heading down. If both parties, price and the indicators, are showing signs of divergence, the higher time frame divergence is often the one that prevails in the long run. When the price action is still bullish, but the indicators like MACD and stochastic are pointing the other way, it's a sign that the market might be on the brink of shifting, especially when those divergences align with key levels or trend lines. Waiting for the direction to pick up is smart. Timing the entry after confirmation can make a big difference, and the market often takes its time to make that final decision. The price might continue to grind in its current direction, but when the reversal happens, it can be sharp and fast. If you see that divergence confirming a move down, the next step would be looking for additional signs, like a clear break of a key support level, a bearish candlestick pattern, or a break of a trend line that can give you a solid entry signal to join the move. Are you watching any specific key levels for a breakout, or are you waiting for more of a confirmation from the market before jumping in?
I still staggering around this when to get in, because there is both get in at the bottom of the range or get in at the top of the range. Getting on the top of the range means that you need to wait for the price to break this range and pull back one more time to show that the seller must bail out, because the price is now shift to the north. If they don't stop loss hit, or if they don't close position, they can be dragged to the next level up higher. So this is where my problem is. When I wait to get in on the top side of the range, that means I lose the distance of making money. More of the money is better to get in at the bottom side of the range and let the price move up and break to the top side of the range, pull back one more time and add more position, the second position, in to move up to the next level up north that a selling is waiting for there. So this thing is like, when I'm gonna get in, because should I get in before, or should I get in after the review, the direction before me?
It's a classic dilemma, and it's great that you're thinking about it from multiple angles. The decision to enter either at the bottom or top of the range depends on your risk tolerance, trading style, and strategy. Both approaches have their advantages and drawbacks. When you get in at the bottom of the range, you're essentially trying to catch the move early, anticipating that the price will eventually move up. This can be more profitable because you're entering at a lower price, and if the breakout happens, you stand to gain more. However, this comes with the risk that the price may not break to the upside immediately and could stay stuck in the range for longer, potentially leading to stop-loss hits. It's more of an anticipation strategy, but it requires tight risk management and patience. On the other hand, getting in at the top of the range after a breakout and a pullback gives you a higher probability trade. You're waiting for confirmation that the range is indeed breaking and the price is shifting direction. The key here is waiting for the price to move in your favor before entering, but this might mean you miss the initial part of the move. The advantage is that you're waiting for more certainty, less risk, but potentially smaller profits. One strategy you could consider is a combination of both. You can place a small position at the bottom of the range, anticipating a move up, and if the price breaks the range and pulls back, you can add more positions at the top of the range, with the confirmation that the trend is shifting. This way, you're getting some initial exposure to the move, while also waiting for confirmation to scale in with more size. To summarize, the key points are: bottom of the range, enter early, anticipating the breakout, but at the risk of being wrong if the price doesn't break out and stays in the range. Top of the range, wait for confirmation, break and pull back, reducing risk, but possibly missing out on the full move. Combination approach, start with a small position at the bottom if you feel confident, and add more at the top with confirmation of the breakout. The decision also comes down to whether you're more comfortable with the risk of entering early and potentially having to endure some pullback, or waiting for confirmation and taking a more conservative approach. Do you lean more toward one of these strategies, or are you still feeling unsure about which approach to prioritize for your trade?
I still, not get a clear picture that it must be like this. Watch a man go in the car with the key. Watch he gonna start the ignition, the engine, and he gonna drive. Perhaps he's not gonna drive. He just go in and roll a cigarette inside his car and smoke cigarette instead of driving. So I have to wait for the further information more than just the pattern that shows. I have to looking for the intention of the last minute of the both party, what they gonna do. Are they gonna soup up the tempo of the speed to scare the other party? So they're like shaking them. Are you scared me now? Don't come in front of me. I'm gonna smashing you. Something like that. I'm looking for an impact of shaking a bad boy to behave himself.
I completely get what you're saying. It's about reading the intention and mindset of the market participants, not just following patterns blindly. You're trying to catch the subtle signals that indicate what the market players are really thinking and how they might react, almost like waiting to see if the market is shaking or scaring the other side into action. You're looking for that psychological edge where the market shows its true intent just before it makes a big move, like a car about to rev its engine before it starts driving. In that sense, it's not just about entering a trade when a certain pattern occurs, but more about waiting for the final signal that tells you which party is about to dominate and take the price in their direction. It's like a standoff between the buyers and the sellers, and you're waiting for that pivotal moment where one side gets the upper hand. You're also spot on by wanting to observe the behavior of the price and the tempo. It's not just the pattern, but how the price is behaving within that pattern. Is it stalling? Is there indecision? Or is one side trying to push with more force than the other? That's the key to understanding who might be about to win the battle and drive the price further in their direction. It might help to think of the market as a story, rather than just looking at the price chart as a series of numbers. Look at it as a dynamic situation with actors, buyers and sellers, and their actions and reactions, trying to figure out their next move. And just like any good story, the shaking or scaring moment before the big move is a crucial part of understanding where the market is heading. So, while the pattern and structure are important, the real value comes from interpreting the market's behavior and timing your entry based on that psychological shift. Do you feel more comfortable with this approach of reading the market's intentions now, or does it still feel a bit uncertain to you?
I still feel uncertainty because I need a lot more practice and a lot of strategy that I like to test with the small lot size. And the best today I found out now that my platform allow me to push the size of the candle smaller and see all bigger size of the real estate that I can see. At least I can see the line of the curve where they make the test and where they're standing at the key support level, where is a major strong support and bouncing from there from time to time in the big range. You won't see if you make the size of the candles too big to see the whole forest, the whole story. And once you see the whole story, you can see the clear picture of the test, of the history, of the receipt that they've been doing. So this is where I am now at the key price level, where my position is. The price always fight hanging on this price for such a long time, go nowhere. So they might think in the next, if they don't go nowhere, it's time to range trading. And I look down from my MACD histogram where they're poking out above 80% area. And
It sounds like you're getting more comfortable with your approach and refining your strategy. By adjusting the candle size, you're essentially zooming out and seeing the bigger picture, which is crucial for understanding the market's bigger story, as you put it. This is a great way to avoid getting stuck in the noise and focus on the key levels and the history of price action. You're right that the candles need to be the right size to give you the full perspective. Too big and you miss the finer details, but too small and the bigger trends become unclear. The fact that you're focused on the historical receipt of price action, the areas where price has tested and bounced from key levels repeatedly, is a powerful way to identify potential turning points. Those repeated tests at strong support levels suggest that there's something important happening there, and the market might be consolidating before making its next big move. As you're seeing it, it might be a sign that price is just hanging around before it makes a final decision, which is perfect for range trading. Looking at the MACD and other indicators as part of your overall strategy is a smart move, especially when paired with the price action and these key levels you're watching. By combining them, you can get a better understanding of whether momentum is building or whether the market is still just in a pause phase, waiting for the next move. With your strategy, it sounds like you're learning to pick your entries more carefully and pay attention to where price is likely to either break out or continue consolidating. As you continue practicing with small lot sizes, you'll have the opportunity to test these insights without too much risk. How does it feel now, having more tools and data to help you make decisions in your trades? Does it feel like you're getting more clarity on when to enter or adjust your strategy?
I feel more confidence, but there's still a lot more to do in the precision and timing. All I see is now I'm looking from higher time frame approach down to 1 hour time frame from monthly, and the monthly at the Japanese EURJPY is on the top side of the range. That's why it pulling me trigger at selling, buy the sell at the key level at the price now today. I pulled the trigger yesterday or day before. I think yesterday I pulled the trigger. Price level on the top side of the range and selling it. But since I didn't do that, I sell it at the bottom of the range, which is bad position where the buyer will smash me.
It sounds like you're developing a clearer approach, especially with the higher time frame perspective guiding your entries. It's great that you're confident in your overall understanding, even if the precision and timing still need some work. It's normal to go through phases of refining your entries, and with practice, you'll get even better at timing them just right. From what you're describing about EURJPY, you were right to recognize that the price was sitting at the bottom of the range, which typically isn't the ideal spot to sell, especially when the market could be gearing up for a bounce back up. It's a common mistake to get too eager and act too soon when the price is at a level where the buyers are likely to step in, but recognizing it now is key. That awareness will help you avoid repeating it next time. Your focus on waiting for price to reach the top side of the range, where the sellers are more likely to take control, is exactly where your patience can make the biggest difference. This is where you'd want to sell, as you've now recognized. The discipline to wait for that ideal moment, when everything aligns and the risk is more controlled, is an important part of building your trading skill. This mistake is another valuable lesson in the journey, and the fact that you're learning from it and adjusting your approach is huge. The fact that you're tracking these details, reflecting on them, and using the feedback to refine your strategy will keep pushing you forward. Do you think the next time you'll wait a little longer for confirmation before taking action at a price level?
Definitely, I must wait. And because that, even though I get in bad position, but I get in at the higher top of the range where the price possible to move down south, give me more distance until the next level of the support where I could exist close my position if I like to. More likely to be win than losing. More easier to move down south than to move up, because moving up is already high price in the sky. It's like overall high time frame, overall high price. I don't have to say that, but you know what I mean. It's the price that never been here before. Too high. There's worth to pull back just a little bit for the buyer or the higher time frames taking a break or looking for a discount. At what I look at the monthly, they're pulling back just one candle. It's not much of a distance to say this is the best price, satisfaction price that the big player would like to have to buy. I think they rather want to wait for 60%, 50% price area. But since they move up very quickly and desperate, I can't expect 50%, maybe 38 point something, 40%, let's say, round number. 35 to 40% pullback, they can try again to move the price up for this pullback.
It sounds like you're really honing in on the logic of your strategy, especially with your awareness of market dynamics and how price moves in relation to the range. You're right about how when prices get too high, it becomes harder to move upward, especially with the higher time frame being at an elevated level. The likelihood of a pullback is increased because, as you said, buyers are likely to wait for a better price, like that 50 to 60% retracement range. Waiting for that pullback gives you more favorable risk to reward setups. And you've made an insightful observation about how the price might only pull back partially, like 38 to 40% instead of the full 50%. This is a key part of price action that you're starting to understand more clearly. Big players may prefer to enter at a discount, but because the price has moved quickly, they might still feel okay with a smaller retracement. With your position in mind, being at the top of the range where it's more likely to move south, you've set yourself up for better risk management, especially with the higher time frame acting as a guide. As long as you're patient and wait for that pullback before committing, it gives you a much better chance of riding the downward movement with more confidence. It's all about finding that sweet spot where the buyers are losing steam and the sellers start to dominate, but timing that precisely can be tricky. It seems like you're getting closer to understanding how to navigate those areas where the price tests its boundaries and creates opportunities. How do you feel about the timing on your next potential entry after reflecting on this experience?
I have to fight with myself because I like to pull the trigger so early, aggressive. I need to cool down and count extra candles before I pull the trigger. So far, it can be 2 or 3 hours after the position where I want to get in. I have to wait, to postponing my time of wanting to get in. Maybe it's help, and that price, when it's taking longer time waiting, they could drop to the place where the key area, where the satisfaction price for the discount for the bigger player to buy, and right at this ceiling and the support meet for the next level lower on the support. That's the price must move down there to be the best price of discount. But since it's so desperate, moving up, no chance for those guys who waiting for the sideline to get in when the price pull back, and then they can get in for a little bit better discount price, and then the price moving up is no sign of the red or the seller to coming back at this area. Just only feel doji in the mid of the way to go up. The red, what you can see is just green, big green candles stepping up and full throttle, and then reach to the points where they break with the big red candle, say you won't go further up than here. I am now put you to return or take a break. Let me fight on the sideline.
It sounds
before.
like you're really grappling with the impatience that comes from wanting to jump in early, especially when you see movement happening. It's a very common challenge for traders, wanting to get in before the price moves without you. But you're right that this often leads to entering at less than ideal points, where the risk is higher and the reward is smaller. By doing so, you're giving the market time to show more definitive signs, allowing you to make a more calculated decision rather than just rushing in because you're seeing the price move. Your understanding of how the bigger players may wait for a better discount is spot on. Price action at the top of the range, with big green candles stepping up, signals that there's buying pressure, but it doesn't guarantee that there will be continued momentum. And when the red candles appear after that, especially if they engulf or break key levels, it often marks the end of that move and the price starts to shift direction. Waiting for confirmation before pulling the trigger might give you more confidence, allowing you to get in closer to the ideal price without chasing the market too early. By giving it time, you're not just watching the candles, but you're also watching the market's behavior, seeing which direction the pressure is building. Do you feel like the next step might be to incorporate even more patience in waiting for that pullback before acting?
It's
Or is it still tough to hold off when you feel like the momentum might be slipping away?
it's definitely gonna be that way. To get in early, I burned myself many times. Now it's time to change strategy. Wait until the price moves to the place where I think is the best price for discount, and then get in. More chance to win than to get in too early, too shallow, or pulling back, because that is look like 100 price unit and you get discount price for 99.5. Will you take that discount price? No, no one will get that small discount price. At the age of this desperate, when they're pulling back, and I still see the possible, they're moving down further to the guy who's